Hello and good morning, everybody, and welcome. Thank you for joining us today. I am Sarah Waits, your head of culture and engagement at Bender Insurance Solutions, and I'm excited to welcome you to another Bender U educational webinar. Today's topic is Cut Healthcare Costs 10% to 25%. Discover whether a health insurance captive is right for your business. We're grateful you've chosen to spend part of your morning with us, and we hope you leave today's session with valuable insights and practical takeaways you can bring back to your organization. Before we get started, I have a few quick housekeeping items. If you have questions throughout the presentation, please drop them into the Q&A section at any time. We encourage participation and want this to be as interactive as possible. We'll answer questions throughout the webinar when appropriate and save additional time at the end for discussion. You are currently in listen-only mode and will remain muted during the presentation. Today's session is also being recorded, and we'll send both a recording and a copy of the slide deck to all attendees following the webinar. Now for the fun part. We have an incredible expert sharing with us this morning, and to introduce them, I'd like to hand it over to our Vice President of Alternative Risk Markets, Roland.
Thank you, Sarah. And good morning, everyone. And thank you for joining us today. Healthcare, as you know, continues to be one of the largest, fastest growing expenses for many employers, especially in California. While most organizations focus on managing annual renewals, some are taking a different approach. In today's session is designed to help you understand how health insurance captives work and why employers are exploring this alternative strategy. To help us guide us through this discussion, I'm pleased to introduce a good friend of mine, KJ Stevens, Assistant Vice President of Business Development with Captive Resources. A little bit about Captive Resources. Captive Resources is one of the nation's leading captive consultants, helping employers across the country take ownership of their healthcare and commercial insurance programs. KJ, thank you for being with us this morning, and I'll turn it over to you now.
Great, Roland. Hey, I appreciate the opportunity. As Roland said, my name is KJ Stevens. I'm going to walk you through this presentation today to talk to you a little bit more about Captive Resources, our captive offerings and captive solutions and how they work. As Sarah said earlier, if you have any questions, please make sure you enter them into the chat box so I can get to those. So the space of healthcare is obviously getting really out of control. The costs are higher than they've ever been before, and the system is broken, right? We've seen healthcare costs go up almost 200% in the last 20 years. And within that, we're seeing certain areas like pharmacy take over the cost of that, or taking over the brunt of that cost, where we see pharmacy taking up almost 30% of your total healthcare costs. And within that 30%, 50% are specialty drugs, right? And so that's what's really driving a lot of this cost. We're seeing renewals higher than they've ever been before, and that's placing a lot of stress and burden on companies, right? You're facing crushing trade-offs. It's a lose-lose decision. It's a lose-lose situation that you're in right now. You're going to get that renewal, right? In a good year, that carrier is keeping all the profit. And in those bad years, the carrier is passing off those costs to all the employers where they're having to pay for it. So the carriers are always winning and always coming out on top, right? So you're stuck. You lose either way. The biggest frustration I have here in California is we don't get data, right? You don't get to see the claims and what's happening behind the scenes and what's driving the cost of your healthcare plan. You have to be a pretty large organization to start seeing that claims data. So when you get these renewals from the carrier, you just have to trust that that renewal is where it's supposed to be, right? Again, you have no insight, no claims, no data. So what we're seeing right now is people are looking for alternative solutions, and captives are a huge answer to that. You know, I'd say a few years ago, 5-6 years ago, captives were there. People were going into captives, but it wasn't as popular. It wasn't as common, right? But now we're seeing a huge demand for captive solutions. And, you know, if the larger companies, let's say 1,000 plus, they've been self-funding for quite a while. It's been very easy for them to do that. It makes sense. Then we're seeing that space, that 200 to 1,000. People have been self-funding and looking at captives in that space for quite a while too. But what we're seeing right now, the biggest growth, the biggest area for opportunity is that 50 to 200. is wide open for that captive solution, and we're seeing more and more demand in this space for employers that size looking for a captive option. So I'm going to give you a quick crash course in self-funding terminology. Now, just some high-level terms that are going to help you understand a little bit more as we go through this presentation, right? So the first thing, when you're fully insured, when you're with, say, Kaiser or Blue Cross Blue Shield, United Healthcare, fully insured, meaning you're just paying that premium every single month, and that carrier is taking 100% of the risk. There's zero ROI on that. You could have 100 employees. You're paying for a really good health plan. Let's just say none of those employees go to the doctor in 1 month. You're still paying 100% of that premium to that carrier. Now, in traditional self-funding, not in the captive, right, you are taking a portion of that risk. We call that the specific deductible. That specific deductible is the amount that you are going to pay per belly button on your plan up to a certain limit. That's your portion of self-funding. You're still purchasing an insurance policy to protect you for anything above that specific deductible, that risk that you're taking on. So that's called reinsurance, and they're going to cover anything up to unlimited. So you're still protected. You still have an insurance policy in the background. Now, the captive, you still have that portion of risk that you're taking, that specific deductible. Now, the captive layer is going to kick in and take the next layer of claims. That's the captive, and that's what we're going to spend time talking about. And then you still do have that insurance policy that protects you for anything above the captive risk and your risk. So the specific stop loss coverage, that's that insurance policy I mentioned. That's going to protect you from the large catastrophic claims, right? One of the questions we always get when we talk about self-funding, people say, hey, I can't self-fund. I can't afford to pay all those claims. Well, the simple answer is you still have an insurance policy to protect you from those large catastrophic claims. Now you have another insurance policy. We call that the aggregate stop loss coverage. The aggregate stop loss coverage is going to protect you from the lower dollar, higher volume claims, where the specific protects you from the large catastrophic claims, maybe the cancers, the preemie babies, whereas the aggregate stop loss coverage protects you from the higher volume, lower dollar cost claims. So you're protected from the high cost claims and you're protected from the mini claims. And the attachment points were underwriting. They're going to look at your demographics, your census, how many employees you have, and they're going to say, hey, here's what we expect you to have in claims. This is the dollar amount we expect you to have. Then they're going to add a corridor, and that corridor is going to be 20-25%, and that's going to be your attachment. So you're going to have a given number that if you get to that, you stop paying claims and you've reached your max cost. So a little bit later in this presentation, we will talk about what that means for you and how you have a maximum defined risk, and we can compare that to your current fully insured premium. The other big thing that we talk a lot about when we talk self-funding is the PBM. Now, the PBM is the pharmacy benefit manager. I mentioned a couple slides ago that pharmacy is driving the cost of healthcare right now. Well, when you self-fund, you get to pick the pharmacy benefit manager that's going to handle all your pharmacy claims, all your dispensing all those medicines. And the big thing is there's a lot of money behind the scenes. We call them pharmacy rebates. There's ways to get the same drug for different costs. You can get that same drug cheaper from a certain pharmacy benefit manager. And so now that you become essentially the insurance company, when you self-fund, you get to get all those rebates, the things that the normal insurance companies right now get to keep. So behind the scenes, they're getting money back on a lot of these prescription drugs that are being prescribed. They're getting to keep those rebates. When you become the insurance company, when you self-fund, now you get to keep those rebates. So there's a lot of money left on the table when you're not self-funding. And then finally, the TPA, the third-party administrator. When you self-fund, the TPA is going to be really handling a majority of the work, the third-party administrator. They're going to be handling, processing, paying the claims. A lot of people think when you self-fund, you're going to be writing a check every time somebody goes to the doctor. That's not the case. That TPA is going to be handling all the heavy lifting. So between a great broker team like Bender and a really good TPA, they're going to be doing a majority of the work. So that's your crash course on self-funding terminology. Hopefully it'll make a little bit more sense as we go further into this presentation. So the way we describe a captive resources is simply it's an insurance company that provides insurance to and is controlled by its owners. Now the key word there is control. When you self-fund, when you go into a captive, you become an owner of that captive. All of our captives are 100% member owned and member controlled. Captive Resources doesn't have ownership or voting rights within that captive. So you're going to have more control than any other insurance situation out there because you are now an owner of that reinsurance company with the other members, and you get to decide how that captive is run. So why group captives, right? That's what we're really going to focus on. Why would you go from fully insured into a captive in today's marketplace? Why does it make sense? Well, before I go into that, quick history, quick background of who we are at Captive Resources. We've been around for over 40 years. We were the very first mid-market group captive, and that's on the casualty side. Bender has a lot of clients with us in Captive Resources, a lot of them coming from the casualty side as well as the medical side. Since we started, we now have over 50 captives. That's going to be both casualty and the medical captives. And within that 50, we now have 11 medical stop loss captives. It's one of the biggest things we always talk about is one size does not fit all. What makes sense for a group with 50 enrolled, that same captive may not be the best fit for a company that has 300 or 400 enrolled. So we have lots of options when it comes to the medical stop loss captives. We have over 7,500 members. Now we call members shareholders or because they are owners of that captive. And so we have over $6 billion of shareholder premiums, and we have a 97% captive retention rate. Now, 97% is captive-wide. On the medical side, our retention rate is actually 98.5%. Now, one thing that's really interesting, when you start looking at how these big insurance companies make a lot of money, they're billion-dollar industries a year, they charge too much, they keep a lot of that extra premium, but one of the other ways is they have a lot of investment income that they get from all that money. So in Captive Resources, we have something called the Captive Investors Fund. We have over $10 billion in assets right now. So any of those available dollars in the captives gets invested, and then the members are owners, right? So they get that investment income. So essentially you are acting just like the major insurance companies out there. So when I talk about control, how do we get that control in the captive? Well, it starts with data. Mentioned earlier, one of the biggest frustrations I have with groups here in California with insurance companies is you don't get that data. You don't get to see what's driving the cost of your health plan, right? When you get that renewal and it's 15%, why is it 15%? Is there a cancer that's happening in the background? Is there a lot of high cost pharmacy that's happening in the background? Well, you don't get to see that. When you go self-funding or when you go self-funded, you get to see literally where every penny goes when it comes to your health plan. You get to see every claim, every dollar, and what's driving the cost. That's in all self-funding. In the captive, you get to see that for yourself as well as the rest of the captive members. But more importantly, we have something called a data analytics platform embedded within each captive. What that's going to do is it's going to take the data for your group, for your company. Now it's going to input it into that data analytics platform, and it's going to tell you a story. It's going to tell you, hey, where are you spending too much money? Where can you save money and what can you do about it? We talk about cost containment, right? How do you control some of that risk happening in your healthcare plan? Maybe you see somebody getting an infusion, very common for people to get infusions, and that infusion might be a local hospital like Sutter. They might be paying $60,000, $70,000, even $80,000 for that infusion. When we know that you can get that same infusion, same quality treatment with even better outcomes at, say, a brick and mortar infusion clinic down the road, for $5,000 or $6,000. So it's going to start telling you a story of where you can save some of that money. Now, the data analytics platform is really important because you get to see that for your own data as well as the rest of the captive. So when the captive members meet and discuss, they're going to be able to say, hey, how can we control risk better in this captive? Because you're all sharing risk together. When every member succeeds, or when you succeed, all the other members succeed as well. So there's a lot of working together to control that cost. The other thing is transparency. As an owner of the captive, you get to see 100% transparency into that captive. Again, you're an owner. You get to see the complete profit and loss statements for that captive. You get to see all the other members' information de-identified, so it doesn't say the company name, but it gives you an idea of how much stop loss premium there is in the captive, how much claims there are in the captive, and that helps you work together. Also, when you get your renewal, you know exactly where it's supposed to be, because you've seen exactly how much that stop loss carrier, the insurance carrier, has paid out for the captive. So transparency is one of the most important parts of our captives, and it really helps us control costs. So what do you do with that data? You implement cost containment solutions. That is the most important part about self-funding, is when we start talking about controlling risk, you can implement solutions to help control that risk. Now, our team at Captive Resources, we're there to consult with you and point out areas where you can succeed, as well as the team at Vendor, right? It's a collaborative effort to make sure we're controlling that risk. Roland, did you have something?
Well, there's a question from the audience, KJ. Thank you. Can you talk a little bit about, I guess, HIPAA, privacy of data? You talk a lot about transparency.
Great
And
question.
obviously, I think that's a question that just came up.
Yep, no, it's a great question. So glad you asked that. So when you self-fund, there's some different ways to handle that. You can appoint somebody on your staff to be HIPAA certified, HIPAA trained, PHI, personal health information. They can be trained in that. And you can have that one designated person who can see that information. Or, and a lot of smaller companies do this when they may not have the resources to appoint and train somebody to that, you can request from the TPA, the third party administrator, to de-identify all the information. So it's going to say, instead of saying an employee's name, it's just going to say a member number, right? The team at Vendor, they might have insight to employee names, so you don't have to. They can make recommendations, but there's two ways to handle that. Again, you can appoint somebody, or you can just keep it de-identified. That's a great question. And we do talk a lot about that on the onboarding and the training with the TPAs. They'll make sure you understand how that all works. So again, the cost containment. I can spend hours talking about cost containment, but our team really, when you join a captive, there will be webinars, conversations at the board meetings, and I'll talk about that when that is. But our members talk, how do we control cost, right? On the casualty side, say on the work comp side, you're trying to prevent things from happening. You're prevent accidents from happening. So you're doing ladder safety training, hard hat training. You're just doing whatever industry you're in, you're training to prevent risk from happening. On the medical side, it's really hard to prevent certain types of diseases, preemie babies, cancers. Now, obviously, there's a lot of things we can prevent, and that's what we do through wellness, right? Lots of different types of cancers, health conditions you can prevent, so we focus on that. But a lot of things you can't, so when it pops up on your health plan, that's when you can implement cost containment solutions to drive down the cost or help those employees get healthier outcomes at better cost. And then the biggest thing we hear from our members when it comes to the captive is the collaboration that happens, right? You are sharing ideas with like-minded business partners. Now, we're not talking same industry when I say like-minded. I'm talking about all these members who come together and they have a common goal of having healthier employees and driving down healthcare costs. Our members know that if they're helping you and you're succeeding, then they're succeeding because your renewals and the risk you're sharing all happens in that captive layer, right? So everyone's working together. They're eager to help each other. They're eager to answer questions, but there's a lot of collaboration together because everyone's in this captive together. And then everyone's favorite thing to talk about when we start talking about self-funding is this right here, stabilizing costs, right? That's why you join a captive. We talk about the healthcare costs, excuse me, healthcare costs are continuing to rise at a rate that's just not sustainable. So when you join a captive, we focus on controlling that cost to keep those renewals lower. So we focus on what we call the other 80%. Now, when you self-fund, about 20% is going to be fixed costs. That's going to be that insurance premium, that stop loss premium. It's going to be the TPA fees. You're paying them to help manage the plan, broker commissions, all those things that are there behind the scenes. That accounts for about 20% of the total cost. The other 80% are what we call claims below spec. Remember, anything over that specific deductible, the captive or stop loss pays for. So what you're paying for is the claims below spec. So we call that the other 80% of your total cost. If those claims don't happen, you don't pay it. Those dollars never leave your pocket. So our members know year over year, they're going to focus on the other 80%, having healthy employees, cost containment, getting the right pharmacy PBM. That's going to save you money, a lot of money long term. And then everyone's favorite thing to talk about is dividends. So in captive resources and all of our captives, any money left in the captive at the end of the year doesn't belong to us as captive resources. Again, we don't own the captive, we're the captive advisor. That's our members' money. So 100% of whatever's left at the end of the year goes back to the members in the form of a dividend. Now, it's not a credit to next year. It's not something that you have to stay in the captive to even get. Most members do, but that money goes directly back to you as a company, right? And so that's how the captive works, is that money that comes in, anything left over goes back to the members. So talking about controlling costs and controlling the risk, our average renewals right now are 9.8%. Now, 9.8% would be good in the fully insured market. We're seeing these renewals now are 12, 15, even 20%. But when I say 9.8%, that's just on the stop loss premium. So let's say you had $1 million of fully insured premium, right? 9.8% on that renewal is, again, still better than industry standard right now, but it's a lot of money. When you go self-funding, you're only paying a portion of that premium. Your stop loss premium would be about, I'd say $300,000, $350,000 if you had $1 million of annual spend. So your 9.8% renewal is on that stop loss premium, which is drastically lower than that fully insured premium, right? Industry average right now in stop loss in that stop loss market is around 15 to 20%. So other captive competitors of ours, traditional stop loss, we're seeing a lot higher renewals than what we're coming in at with captive resources. Now, 5% is going to be the attachment. The attachment is the amount that you pay in claims. Now, industry standard, I think, is around 8%, so we're a bit lower than that. Not as drastic as the stop loss premium, but 5% is a really good renewal on the attachment. And then we're seeing about 15% of premiums available to return to members. Now, that's the dividends I talked about. I'll get a little bit more detailed into that in a minute here. But again, that's the members' money, so 100% of it goes back to our members. So when I talked about transparency a few minutes ago, this is what it looks like. So when you join one of our captives, every year that you're a member in the captive, you get to see your net equity in relation to that underwriting year. So here's an example of what this would look like. And I'm not going to spend a ton of time on this, but you get to see your total premium, how much stop loss insurance you're paying. Now, from there's a certain amount of that money that gets seeded into the captive to pay for claims. So in this example, this company had $511,000 of stop loss premium. That's their insurance policy. And of that, $307,000 went to the captive to pay for claims. You can see this particular group had $130,000 of claims that year, right? That's the amount over their spec deductible that hit the captive layer, okay? So they had to take $130,000 out of their $307,000 loss fund. This group would be getting $177,000 back in the form of a dividend. But then there's going to be some risk sharing. I'm going to talk a little bit more about this in a minute. But all insurance has risk sharing. If you're fully insured with Kaiser right now, when you get your renewal, there's a lot of risk sharing making up for all the bad groups out there, right? If you're with one of the PPO carriers like Anthem or Cigna or Aetna, your renewal is always going to have risk sharing in it. When you self-fund, traditionally, not in a captive, there's always going to be risk sharing in your renewal. The biggest difference of captive resources is you get to see down to the penny how much risk sharing is happening. And then you can see from this group, there is a risk sharing, and then they're going to get $111,000 back. So again, total transparency into the process. And as an owner of this captive, you get that every year. So how does the captive work, right? Roland, do you have a question?
Question from the audience. I think you drove some curiosity when you mentioned dividends.
Yeah.
How soon does a member receive a dividend if they're in a captive, and does each year stand on its own?
Great question. So if anyone out there on this webinar is familiar with us on the casualty side for work comp or liability, those dividends get paid at 5 years, right? There's a really long tail end to those work comp claims where they're ongoing and you can't close out the year because some of these work comp claims are open. So they can't pay dividends until that year is closed out, often taking 5 years. On the medical side, those dividends are paid in 18 or 24 months, between 18 and 24 months. Now, the only reason is at the end of the captive's plan year, every member in the captive has the same stop loss renewal date. Your medical date can remain the same. Stop loss renews on the same date for everybody. It's going to take about 6 months for all those claims to be finished being paid and processed by the carriers. And then we have to audit the accounts and make sure everything's good. Well, by then the first board meeting has already passed. Since our captives are member owned, Our members have to vote to close out the underwriting year. So then we have to wait till the following board meeting to do that. So that's why it takes 18 to 24 months. But again, it's going to be much quicker than if you were familiar with on the casualty side. Good question, though. So how does the captive work? So again, when you're fully insured, you're paying 100% of that premium going to the carrier. They're taking all the risk. When you self-fund in the traditional market, you're taking some of the risk through that specific deductible, and then that insurance carrier is taking the next layer of risk. Now the captive, same thing. You have that first portion that you're taking the risk. That's the self-funding portion. The next layer, that captive layer, a portion of each member's stop loss premium is going to get ceded or allocated back to the captive, about 40 to 60% of your total premium. It's not additional money you're putting in. It's just coming from that premium for the insurance company, for that insurance policy. All right. So that makes up that captive layer. And then anything above that, that stop loss carrier is going to pay 100% up to unlimited. So how does the captive flow work? Right? I'll start off by saying your broker becomes more important than ever before, right? Your broker is important. They're doing a lot of great things, but when you're fully insured, especially in California, again, I mentioned we don't get data. When you're fully insured, there's not a lot they can do to consult what's happening behind the scenes in your plan because we don't see data. We don't know what's happening. So when you go self-funded, your consultant becomes more important than ever. And that's why it's really important to pick a broker who understands captives and understands self-funding, because they're going to help you figure out what that data is telling you. They're going to figure out what cost containment needs to be implemented. They're going to be there to now actually consult with you about that health plan. Now that TPA, that third-party administrator, I already mentioned this, but they're doing all the heavy lifting. They're paying and processing the claims. They're renting the network. So when you self-fund, you still have access to the major PPO networks. Now, question I always get is Kaiser. We cannot do Kaiser, right? So a couple different options there. If you have enough enrolled on, say, a PPO plan, we can do a slice option where we keep Kaiser in place. We do need, the minimum we can go down to is 40 enrolled for the captive, all right? We can go up to pretty much unlimited, but we need that 40 enrolled. So a lot of times we see, say, 40, 50, 60 on a Kaiser plan, and then maybe 40 or 50 on that PPO plan for employees that are out of, say, Sacramento area, that might be out of state, or in an area in California where there's no Kaiser. Well, we can then put those people on a captive and keep that Kaiser in place. What we are seeing a lot more of now, and I would have never thought this would have happened a few years ago, companies saying, we just want to get rid of Kaiser. Those renewals have been so high and we're tired of just getting those huge increases every year. We're ready to pull the Band-Aid and replace Kaiser. So you have options, right? You have options that we can definitely talk about. But that TPA is doing all the heavy lifting. The networks they can access are going to be those national PPO networks, Cigna, Aetna, United Healthcare, Anthem, Blue Shield. Now there are regulations about how many enrolled are needed to access some of those networks. So we can certainly talk about that if you're interested. Now, the other question we get is, what's the employee experience? What are the employees, what's happening to them? Really, all employees care about for the most part is their ID card, right? What network do they have access to? What phone number do they call when they need help? And how much it's going to cost. So they're still going to get that ID card that doesn't say anything about the fact that they're in a captive. So employees don't have to know. Excuse me. Some of our, I'm so sorry. All right, hopefully that helps. Some of our groups prefer to kind of cast that vision to the employees and say, we're now self-funding, we're in a captive. We're going to talk about wellness plans. We're going to talk about how you can stay healthy. So they want to cast that vision to their employees. You can certainly do that if you want. The stop loss carrier is going to be paying for those claims that are above your responsibility. And then the captive, we're the captive manager at Captive Resources. Now we're domiciled in Grand Cayman. The reason we're in Grand Cayman is almost 50 years ago when we got our start, captives weren't allowed in the States. No one knew how to manage them. No one really knew what they were. And so at the time, there were large companies that were had something called a single parent captive, and they were either in the Bahamas or Grand Cayman. So it made sense for us to go to Cayman. Now, 50 years later, and over 50 captives, we have a captive manager there. We have the infrastructure. Grand Cayman is actually the highest domicile for insurance and banking in the world, and it's very heavily regulated by UK banking law. So very, very much strict and regulations are in place there. That's where our sister company, Kensington Management, handles all the managing of the captive, handles the funds, and then sends those dividends back to the members at the end of the year. And again, captive resources, we are the captive manager. We are there to make sure the captives are running efficiently and effectively. And we're also making sure that we're only letting the best risk into the captives, because we answer to the owners of the captives. So we have to make sure that we're gatekeeping and only letting people in who understand what's expected of members and that have good risk. So talking about our different captive options, I mentioned earlier we have 11 different captives. The reason we have 11 different captives is simply one size does not fit all, right? So we have two different structures when it comes to our captive. If you're in one of our casualty captives, you might be familiar with the risk reward captive. That's how we got our start. Now, the risk reward captive appeals to companies that want to bet on their own performance, meaning your dividend is directly tied to the performance of your health plan. So, you know, if you have a good year with low claims, you have a greater dividend upside. That's the reward side of the risk reward. On the risk side, there's a little bit more risk, meaning you might have to pay a higher assessment in a bad year. And I'll talk about what that is, but that's why we call it the risk reward captive. Multiple entry points, meaning you can be currently fully insured, self-funded, or a level funded plan, but there's a risk reward captive that could fit you. The pooled captive. Now, there's a lot of captive competitors out there in the marketplace, and most everyone, to my knowledge, has a pooled model. The pooled model has a little bit less risk and a little bit less reward. It's more stable. So it reduces the individual volatility of some of these companies. You can still do all the great things that you can do when you self-fund in a risk reward captive, but now you're in a pooled captive. So the risk is now spread out amongst the pool, right? So it's collective accountability, which means if you're getting a dividend, everyone in the captive is getting a dividend. The captive has a bad year and needs a little bit more money, then everyone else is going to pay an assessment to true that captive up. So less risk, less reward. You still have all the functionality of being self-funded and controlling costs. So the captive is going to act essentially as a shock absorber. So in the traditional marketplace, you have a lot of volatility with your renewal. I'm sure a lot of you have seen renewals in good years. We don't really see too many good years anymore. I've seen some great renewals in the past where companies might get a 5%, 4%, 5% renewal. Now we're seeing, again, anywhere from 12 to 20% renewal. So a lot of volatility in that traditional marketplace. Now, when members join a captive, it spreads out that risk. It acts as a shock absorber to decrease that volatility. And captive members really work together and talk about best practices and collaborate to reduce the risk in that captive layer and make for those better renewals and the higher upside in those dividends. So the pooled captive, how does that work, right? The pooled captive, basically you still have that specific deductible. Every member picks their own specific deductible. So if the captive had 100 members, every member picks their own layer of individual risk. Now the captive layer in the pooled model, a portion of that, I mentioned earlier, a portion of everyone's stop loss premium goes into the captive. Well, in the pooled model, all those dollars go into the captive bucket, right? If the entire captive, whatever's left in that captive at the end of the policy year is distributed back to the members based on what they put in. So equal percentage based on what you put in. Very much all for one, one for all type of deal here, right? A lot of companies in California choose the pooled model. We don't expect you to have to know which captive to go in. That's what we're here to help you figure out what's the best fit for you. But in this pooled model, if the entire captive's loss fund is used and there's no more money left, there's going to be a true up at the end of the policy year. That's what we call the assessment. Now the assessment's a max of 25% of each member's loss fund. That would be the max, and that's part of the max cost. It's on the proposal. It's not going to be a hidden cost or a surprise at the end of the year, right? But that's how that pooled model works. It's very much a collective effort. Now the risk reward captive. Again, this is how all of our casualty captives are designed. Same thing where a portion of each employer's stop loss premium is allocated, but instead of going into the pooled model where everyone's dollars go into one bucket, each member in the captive gets their own loss fund. Now the loss fund is theirs. That's what their premium dollars go to, and they're going to pay for any claims that come in that captive layer from their own individual loss fund. Now, you're not actually doing it. You're not writing checks. It's all happening behind the scenes with the captive manager, but it's coming from that individual loss fund. Now, whatever's left in that loss fund at the end of the year, minus any risk sharing, right? Whatever's left in there goes back to that member. It's their money. They get that dividend back. So their dividends based on their individual performance. Now, if you have a bad year and your loss fund is depleted, before the other members step in and help share that risk, you would pay the assessment. Now, the assessment in the risk reward captive is going to be 20% of your loss fund. You don't have to pay the entire assessment if it's not due, if it's not warranted. But if it was, the max you would pay is 20%. But if that's the case and you pay that, you've hit max cost. You're done. If there's any other claims in that captive layer that your company has, it's going to then be spread out through that risk sharing. Now, the question I get a lot is, why would I want to be involved with anything where there's risk sharing? It's a great question. By definition, insurance is risk sharing. There has to be risk sharing for it to be considered insurance. Now, in the fully insured marketplace right now, which I'm assuming most all of you are in, the fully insured marketplace, there is a ton of risk sharing happening, right? In California, the small group, so under 100, it's all a pooled renewal. So you don't get to know how much is based off of your own claims or how much is based off of risk sharing. Everyone's getting that renewal, but it's all based on risk sharing, right? If you are larger than 100 and you're in the large group market, now technically your renewal is based off of your own risk, the claims you had that year, but there's always going to be a large percentage of that that's going to be risk sharing. Again, that insurance company is always going to come out on top. In the good years, they keep all the profit. In the bad years, they're passing all that cost and risk back to the employers. You just don't get to see how much of your renewal is your risk based off of or other people's risk. When you join the captive, you get 100% transparency down to the penny. How much of your renewal is based off of your claims and what's being given to risk sharing. Now, the biggest difference is your renewal in the captive is not going to have any risk sharing in it, because it compounds every single year. Your renewals rarely go down, they always go up. So the risk sharing happens in the current year through that assessment and through the risk sharing in the captive. So it does not affect your renewal, right? So your renewal is right where it should be based off of your individual risk. So I'm going to give you an example of what it would look like if you got a proposal with us, because the question we always get is, what's it compared to my fully insured cost and what's my max risk? What's my max liability? Again, common misconception when we talk about self-funding in a captive is you have unlimited risk because people think you're self-funding, so you're just paying unlimited claims. Well, that's why you have that insurance policy to kick in, and that's why you're going to have your max cost. So this particular company that we're going to look at, ABC Company, 120 enrolled employees, their total fully insured premiums, $1.5 million. This company is going to go with a $70,000 specific deductible. Now that's going to be what their broker helps them decide, right? We don't expect you to know what your specific deductible should be. It's based off of company size and the amount of risk that you want to take. So their stop loss premium, that's the amount for that insurance policy, is going to be $350,000. Now from that, 210 is going to their loss fund. It's not an additional 210. It's just coming from that stop loss premium. Now their expected claims, when underwriting looks at this company, if there is claims that they have available, they're going to look at that. But again, in California, we don't really get that. So they're going to look at the demographics of the census and say, what is this census demographics? What's the typical cost for this type of demographics on the census? And that's how they're going to come up with that claims expected, $1 million. Then they're going to add that corridor. We call that the aggregate attachment. So 1.2 million. They get this $1.2 million, they're done paying for claims. That's their max cost on those everyday claims. So now we can show you administration costs. Obviously, that's going to vary depending on the TPA, broker commissions, and all that, but we'll say $90,000 for this group is just going to be admin. Now, the stop loss premium is the other fixed cost. That's the amount they're paying for that insurance company or that insurance policy, $350,000. And at max cost, we talked about the assessment, right? That's going to be part of your max cost, $42,000 for this group would be 20% of their loss fund. Attachments 1.2. So all in, max cost on that year, worst case scenario would be 1.6. So we know that's an 8% risk for this company to take to join the captive. Now, typically companies fund to max cost, meaning that's how much they're collecting in employee premium and how much they're giving to the plan. So if that assessment did happen, that money should already be accounted for through that employee premium. Now at expected, right? Expected, we're saying, hey, admin costs, stop loss premiums the same, no dividends. Dividends are icing on the cake. So we model no dividends at expected. And we can show you here, they've reached expected on the claims, coming in at -7% compared to that fully insured premium, whether it's current or the renewal premium. So when we get that, when we work with the vendor team and we come out with what your renewal would look like, we'll compare it so you can make a very educated decision. Is this a good risk? Does this make sense for us to join the captive? And then of course, now we can show you what a good year looks like. You're getting a dividend, you have less claims than expected. Now, the interesting thing about these claims right here, these dollars never leave your pocket unless a claim happens, right? So you're self-funding. So if people are healthy and not going to the doctor, those dollars are never leaving your bank account, right? You're only paying for those claims as they occur. So we can see here, obviously quite a bit of savings, and we can model all the way to what it would look like at fixed costs. That would be a fantastic but impossible year, right? So you're only paying the fixed costs. So we're going to model this for you so you can see exactly the risk you want to take. Now, how do the claims work in the captive, right? How does it work when you have those claims? So same company, $70,000 specific deductible means they're going to pay the first $70,000 for any claims. That sounds like a lot of money, right? You're thinking, wow, $70,000 I have to pay for an employee to go to the doctor. Compare that to that $1.5 million of fully insured premium. It's actually a lot less. So you're seeing $70,000 specific deductible, that $350,000 insurance premium. Of that, 210 goes to the loss fund. Then the next 140 is going to be operating costs. Now on your proposal, it breaks down line item what those operating costs are. It's not just the fixed line that says operating costs. It breaks it down line by line of who's making what and where it's going. And this particular captive has a $200,000 captive layer, meaning any claims above that specific deductible, the captive takes the next $200,000 layer of risk. This company has $210,000 to pay for any of those claims that happen in the captive layer. Now, anything over the first 70 and the next 200 are going to go to that stop loss carrier, and they're going to pay up to unlimited. So let's look at a couple claim examples of what that would look like. So this year, let's say it's their first year in the captive, and they have a $120,000 claim. Could be a cancer, could be surgery, but there's a $120,000 claim. Well, this company would then pay the first 70 of that claim because that's their risk, that's their self-funding portion. Now we see there's $50,000 left over. Well, our loss fund, this company's loss fund's 210. That's the money they have to pay for claims. 50,000 is going to come from that bucket, and they're left with 160,000. This is their potential dividend. There's always going to be risk sharing, right? Again, all insurance has risk sharing. We take care of risk sharing in the current year, not on the renewal. So whatever is left over after risk sharing is going to go back to that company in the form of a dividend, right? So this is money that the insurance company would have otherwise kept. Now next year, let's say they have two claims, right? Two claims, 120, 160, same thing. You're paying for the first 70. We're left with 50 and 90. Our loss fund's 210. We know that's $140,000 that's going to be paid for those claims. Now this company is left with $70,000 potential dividend after any risk sharing. Again, that's the money the insurance company would have made off of this group. But now that you are the insurance company, you get to keep those dollars that are not used. Now, the question I always get, and I always want to end with this when I talk about claim examples, what happens when I have that horrible year? It's not a matter of if, it's a matter of when. It will happen, right? When you self-fund, when you're fully insured, you're going to have that max cost year. Now, all the insurance companies know that. They're making so much money on all the other years that when they know that bad year happens, they're still going to come out on top, right? And so this year, you can see two claim examples, $160,000 claim and that dreaded $1 million claim. So what happens there? You pay the first 70 for each claim. We're left with 90. And on that $1 million claim, we're left with 200. Why 200? Because our captive responsibility is $200,000. And you can see that stop loss carrier is going to pay the next $730,000. If you were traditionally self-funded, not in a captive, so there wouldn't be a captive layer there, that stop loss carrier would have paid $930,000 claims. So when we talk about our lower renewals than industry standard, part of that is because the captive layer absorbs a lot of those claims. So simply stop loss is paying less claims. So how does that work? Well, $210,000 loss fund, $290,000 of claims. So there's obviously going to be a deficit of $80,000. This is where that assessment comes in. This company is going to pay that assessment for this year, $42,000 based on their premium. And this is left with $38,000 that's going to go to risk sharing for all the other members. So the captive rewards you in the good years, protects you in the bad years. Now, one of the questions we always get is, are other members going to be mad at us and point fingers at us when we cause risk? A couple different answers to that. One, you're de-identified, right? So no one knows the name of the company when they see all the claims in the captive layer. But two, the simple answer would be no, because all the other members know that if they are having a good year and you're having a bad year and they have to help you out, the tables are going to turn. You're going to be having a good year, and there's going to be another time where they're having a bad year and you're helping them out. That's how that risk sharing in the captive works. 1 in 5 years, actuarially speaking, people who are way smarter than me, and this isn't just captive statistics, this is all insurance, health insurance, 1 in 5 years is going to be a bad year. We know the other 4 years are going to be break even or years where you're actually getting money back, right? So this would be that bad year. So in our captives, there are some upfront costs. I think most captives have this, but ours are a little bit different because you are becoming an owner. So upfront, every member, regardless of size, is going to pay a $20,000 in capital. That capital gets you 2 ownership shares within the captive. $100 gets you a common share. That's 1 equal vote for every member in the captive. Your vote's not based off of size. It's not based off of amount of premium. Every member is an owner, and every member gets 1 equal vote. The other 19,900 is what we call a preferred share. That's how those dividends go back to our members. Now, I mentioned the captive investors fund a bit earlier. That $20,000 gets invested. You're going to get investment income off of that. And if you ever left the captive for any reason, you're going to exchange your ownership shares. So you get all that money back plus the investment income. There's no strings attached. You're just exchanging your ownership shares and you get that money back. Now, the other cost is going to be what we call collateral. I mentioned that assessment, the amount that you have to put in a bad year, the true up. So collateral is going to match whatever your assessment potential is. So it's different for every member coming into the captive. You can either pay a letter of credit, cash, or a combination of both. Most our members prefer paying cash if they have it, because again, it gets invested in the captive investors fund. You get that investment income. Now, it sits as an asset in your books, and we don't ever use the collateral. It's basically a security deposit. The only situation where we would use that is, let's say a member had a bad year, they have to pay an assessment, but they're just like, forget about it. We're closing our doors. We're not going to pay anything. We're declaring bankruptcy, whatever it is, worst case scenario. Well, that means the other members in the captive would have had to pay that assessment. Our members agree to share risk, but they don't agree to share bad debt. So in that situation, we would keep the collateral to pay down that member's assessment. We've never had to do that on the medical side. We don't expect we ever have to, but it's just there to protect all the other members. If you ever left the captive in good standing with no outstanding assessment, you get 100% of that collateral back plus any investment income. So again, we don't use the collateral. It's just what I call a security deposit. Worst case scenario would be if a member didn't pay their assessment, then we'd use it. So that's the upfront cost. That's the ownership in the captive. So I wanted to finish with a story of an actual member in our captive. What would it look like transitioning from fully insured to the captive, and what would that look like? So member success story, this company has 90 employees, right? Out of that 90, 76 are enrolled. Assuming it's a fully insured PPO type of plan. This is back in 2022. Their fully insured premium would have been $1.1 million. This company was really frustrated with the increases, the lack of transparency. They were just tired of what I call the hamster wheel of death, right? Getting that renewal every year and not having any insight to what's driving the cost. So on their captive proposal, This group chose the TPA, the third party administrator. This one's called Meritain. One of the things I want to point out is you can have any TPA, any PBM within our captives, right? We don't have a list that you have to pick from. Whatever works for the vendor team, which they think might be the best TPA, or you think it's the best TPA, you can go with. This particular group went with one called Meritain. Their network was Aetna. And what they did to really help save money long term. I talked about pharmacy being one of the leading drivers, and we talk a lot about this at our meetings. They went with a specialty pharmacy vendor, meaning some of these high cost drugs, they get really laser focused on how to save money and get those at the best possible cost. So they went with a specialty carve out, and they went with a specific deductible of $50,000. That's the amount that they're going to self-fund. So what we saw here on their proposal, and this is a really good proposal. I wish every proposal looked like this. I'm in sales, so of course I'd like for it to look this good. But at max cost compared to their fully insured premium, this proposal was minus 7%. At expected, that's going to be where we expect you to come in everyday claims. They were at minus 19%. This was a no-brainer for this group to join the captive. Now, typically what I see when it looks at these proposals, a good proposal might be minus 8% at expected, right? You can save some money year one potentially, but with max cost, there might be some risk. It might be 6 to 8% risk at max cost. Again, that doesn't guarantee it's going to happen. It's just your max exposure, right? So this proposal is really good. So this company joined. And what we saw, here's their transparency sheet, right? Their member equity statement. So in year one, they had $382,000 of total stop loss premium. That's the fixed costs. From that, 214 went to their loss fund, what they used to pay for claims. They had a really good year. They only had $15,000 of claims over spec, their responsibility, right? So that $15,000 came from their loss fund. It left them with $199,000 left over. They didn't have to pay an assessment because they had a really good year. $23,000, $24,000 went to risk sharing. Again, I always want to stress this. All insurance has risk sharing. The biggest difference is in the captive, you get to see down to the penny how much risk you're sharing, how much risk you're causing, how much you're absorbing, right? So they help share $23,000, $24,000. So their loss fund, $175,000. That's the money, their dividend that they would have gotten back the first year. Now, the second year, they had a little bit rougher year. They had some high cost claims. Some people get sick, have surgeries, cancer, whatever it may be. So their stop loss premium was $360,000 that year. $200,000 went to their loss fund. They had $381,000 of claims over their specific deductible. It's a rough year, right? I said 1 in 5 years. Their second year happened to be their rough year. So they had $180,000 more in claims than they had available. So they caused that in risk sharing. So they did have to pay their assessment, the full assessment. They caused $140,000 of risk sharing after they paid their assessment. They didn't get a dividend that year, right? Not a big deal. It's going to happen. The next year, you can see they did much better and they got a $38,000 dividend. So all of our members, as long as you're in a captive, you get to see your total equity statement, including your upfront costs, your capital, collateral, investment income. So all up after 3 years, they're up $173,000 total in the captive. With all the other costs, they're up $240,000. So again, that's just an example of a member. What I do like to point out, what would have looked like if they stayed fully insured? Now, of course, we don't know their exact renewals, but we're estimating about, I think, 12 to 15% renewals, which is pretty common, right? So starting in 2020, their fully insured renewals will just continue to go up. Renewals rarely go down, right? So you can expect there's zero ROI in the fully insured plan, and you're just going to get these renewals year over year over year. So we're projecting by 2030, this group is going to be paying close to $3 million, right? That's just unsustainable. It's not going to work. If they went self-funded in the traditional market, not in a captive, they're going to do a lot better than the fully insured market. You can see here, pretty equal to their captive dollars, but then traditional self-funded renewals are still much higher than ours. No dividends typically in the traditional self-funded market. So after, by 2030, doing better than the fully insured market, but not as good as they could be. Now in the captive, even with those bad years, right? We modeled that bad year. We can say, hey, in 2030, they could have saved over $2 million in the first 5 years, just not paying those claims and saving the money. And then over that 10-year projected savings of $6.8 million. So there's a lot of cost savings within the captive. Obviously, it's going to be different for everybody, but this is really where it comes to talk about controlling costs long-term. Now, one of the questions I get asked is, how soon can we see savings, right? That's a great question. Obviously, in this example, year one, they saved a ton of money. It doesn't always happen that way. In fact, I have employers say, we know we might pay a little bit more money year one. We can't get that proposal down to minus 19%. It might even be plus 2 or 3%. We have a lot of members who say, we understand this captive. We understand that long-term, we're going to save a ton of money. So we're going to pull the Band-Aid. Might be a little bit more upfront, but we know by year 2, 3, 4, we're going to control costs and we're going to be well under the traditional market. So there's a lot of savings, may not be exact year one, but when you control costs year over year, there's going to be savings. So I appreciate it. That was a lot of information. I am available for questions. The Bender team has my contact information. This typically isn't something you hear once and say, I'm all in. Maybe it is, that's great. So if you need more education, more questions, of course, getting a proposal so you can see what those numbers look like, we are happy to help. Again, we work real close with Bender, great partnership there. So happy to answer any questions you may have in the future.
Hey, KJ, we do have one final question from the audience. And of course, I have a couple myself, but the question is, my renewal is December 1st. When should I start the process for considering a captive?
It's a great question. Yeah, so depends if you're fully insured or self-funded. Fully insured, we can actually start now because especially at small group in California, there's going to be no data. So the quote's not going to be based off of your data that we're going to receive. So we can actually start that now. The quote won't be firm until we actually get your renewal, but it'll be pretty close because we can kind of project what that renewal would be. If you do have data, we can actually start looking in July because that's usually when that data is updated. So that's a great question. We can start pretty soon with that.
Perfect. And then I know we didn't have a slide on this, but regardless if it's a casualty captive, the health insurance captive, Captive Resources does a really good job in education. Can you talk about the value in the workshops specific to the health insurance captives and what that means to members?
Yep. So there are meetings, right? You are an owner of the captive. So there's going to be a board meeting. Board meeting happens once a year, and the casualty side is twice a year. The board meeting is where all of the members, the owners of the captive, get together. They discuss the risk that's happening in the captive, how the captive is performing, the finances, and then they vote on how the captive, what needs to be taken care of within the captive. There's another meeting we call the Health Risk Management Workshop. Now that's going to be very specific to controlling risk in the captive. So what's driving the cost? Is it going to be cancers? Is it going to be GLP-1s? What can we do about it? People are going to share success stories on cost containment and help other members learn from that, as well as Captive Resources team will talk about solutions that are out there in the marketplace, best practices, so very much hands-on into controlling the risk of the captive, as well as monthly webinars. But we do see a lot of value from members reaching out to each other throughout the year, Roland. You might have seen us on the casualty side. Members are very eager to help each other because, again, they're co-owners of the company and they're sharing risk. So members are always happy to help if other members have questions.
Great. Thank you, KJ. Very much appreciated. And, I'll just throw in a couple closing remarks. KJ hit upon transparency, control, and dividends. I view dividends as the carrot. That's the big unknown in traditional insurance. And that's the known in any type of captive program, and full transparency. When we're meeting with our clients that are in traditional health insurance program, and we're talking about, hey, congratulations is only a 5, 7, 10, 15% increase. We have limited data. The captives change that. So to me, I think transparency is one of the biggest benefits. Again, thank you, KJ. And if you can flip to the next slide, that would be awesome. Awesome. For those that have attended our Bender Use in the past, look forward to having you again on, please join us on July 16th at 9:30 a.m. The topic is, should you bring an outside attorney to be an investigator? When to hire, what to expect, and mistakes to avoid in employment investigations. Sarah, back to you.
Wow, that was amazing. Thank you so much again to Roland and KJ for sharing their expertise with us today. We appreciate everyone taking time out of your busy schedules to join us for today's Bender U webinar. As a reminder, this has been recorded, and both the recording link and copy of today's slide deck will be emailed to you following the presentation. If you have any questions come up after today's webinar, please don't hesitate to reach out. Our team will be happy to continue the conversation and help determine whether a health insurance captive may be a good fit for you or your organization. Thank you again, and we hope you have a wonderful day.